day, everyone, and thank you for joining us for our call today. My name is Jason Lisui, Executive Vice President at SIA Wealth, and I'm joined by our Chief Market Strategist, Colin Sinzinski. First, I'd like to thank everyone for your support and feedback over the past 8 weeks regarding our market update webinars. We've received a lot of great feedback, and we're glad you're finding a twofold agenda. First, I will continue with our Advisor Alpha discussion. 3 weeks ago, we laid the foundation for Advisor Alpha on our April 22nd webinar. Then we discussed how to apply it in your clients' portfolios on the April 29th webinar. Today, we'll provide a framework for how you can market and communicate this idea to clients and prospects. Then I'll pass it over to Colin, who will provide his insight on the recent market activity. Again, as a reminder, if you have any questions, please don't hesitate to type them into the question box, and we'll answer them at the end of the presentation. So as a quick recap, we define Advisor Alpha as the value advisors add to clients' portfolios through a macro investment process that prioritizes risk management and tactical investing. We believe risk management is critically important for all investors to understand, really for 3 specific reasons. The first reason is risk management's impact on your client's time horizon. The second is risk management's importance for mitigating large drawdowns. And the third, risk management's role in prolonging your client's investment portfolio during retirement. So on the next slide, we'll talk about reason number 1, which is risk management's impact on your client's time horizon. So most investors focus on the loss of capital as the real impact of large drawdowns. However, the real issue really is the loss of time. We expect our portfolios to move up and down with the markets over time, and so we're somewhat prepared for that. However, what is often overlooked during large drawdowns is the impact it has on your time horizon to reaching your goals. Capital can be regained, but the loss of time cannot. So ultimately, time is everyone's most valuable commodity. This is a chart of the TSS Composite Index going back to 2000. And you can see here on March 23rd of 2020, the index hit its current low for this year at this point at around 11,000 price level. This is the same level it was back on August 28th of 2000. Effectively, over a 20-year period, the index is back to where it started. And even after the record-setting stimulus package from the Bank of Canada and the Canadian government in March, the index rose to around the 15,000 level. Again, the same level it was 12 years earlier on May 15, 2008. So more important than simply losing the value in your portfolio, you've lost time to grow your money to reach your retirement goals. Again, managing large drawdowns is really the key to reducing the effects of lost time. On the next slide, we'll discuss point number 2, which is risk management's importance in mitigating large drawdowns. So we're often told that equities outperform bonds over the long run. So if you have a long enough time horizon, it's recommended you overweight equities in order to reach your retirement goals. And while this relationship has proven true over long periods of time, the important question is, how do you define long periods of time? Here's an example of a 20-year period whereby a hypothetical or fixed income model outperformed a hypothetical all equity model. The reason for this is the impact that large declines had on the all equity model. Looking back on this, we saw 2 bear markets between 2000 and 2003, and again in 2008, 2009, followed by significant corrections in 2011, 2016, and again in 2018, and then finally another bear market here in 2020, all contributed to a volatile 20-year period for the all equity model. By not managing large drawdowns on this model, the all fixed income model outperformed it over the past 2 decades with much less risk or volatility. And we're certainly not suggesting that we expect fixed income to repeat its performance over the next 20 years, but simply making the point that large drawdowns experienced by the equity markets meant that over the past 20 years, this equity model didn't perform any better than this fixed income model. The next slide, we'll talk about the third reason risk management is so important, and it's focusing on the role that risk management plays in prolonging your client's investment portfolio during retirement. So risk management becomes very important for those investors entering retirement and begin drawing down on their investment portfolio. Here's an illustration of this concept developed by the BMO Financial Group that demonstrates the importance of the sequence of returns during the drawdown phase. 3 portfolio examples are shown, each with an average annual return of 7% over 7 years, and each withdrawing $100,000 a year. Portfolio 1 illustrates a constant 7% return each year, and over 7 years, the $1 million portfolio is valued at around $740,000. Portfolio 2 has a different return path and starts out with a plus 15% return in year 1, followed by minus 5%, plus 2%, and so on. And it ends year 7 with a value of approximately $705,000. Portfolio 3, though, begins its drawdown phase with 3 negative return years, minus 13, minus 5, and minus 8%. And even though it posts very strong returns in year 6 and 7, it couldn't make up for the initial losses incurred at the start of the withdrawal phase. And so its value after 7 years falls to around $403,000. Therefore, the value of portfolio 3 erodes more quickly when you begin with negative returns during your retirement withdrawal period. This is why the first years of retirement is so important, because experiencing larger drawdowns early on may result in your client outliving their savings. On the next slide, these charts illustrate the nature of the markets throughout an entire bull bear market cycle. Again, we define advisor alpha as the value advisors add to clients' portfolios through a macro investment process that prioritizes risk management and tactical investing. The chart on the left highlights the benefit of tactical strategies during the bull market periods, like the period from 2009 to 2019, by overweighting markets showing strength and underweighting markets showing weakness. The chart on the right highlights the benefit of unconstrained mandates during bear market declines, like the recent crash here in Q1 of 2020, through its ability to reduce equity weighting to 0 and sit in short-term bonds. On the next slide, really at the end of the day, we have designed all our mandates with the goal of navigating an entire market cycle. So the question for everyone is today, do you believe the need for tactical investing and risk management going forward has increased or decreased? Do you believe the global economic environment post-COVID-19 will result in more or less risk to the markets? If your answer is more risk, then now is the time to embrace risk management and tactical strategies. You have an opportunity to restructure your portfolios before the next crisis occurs. As the saying goes, success is reserved for those who are prepared. And with that, I'll now pass it over to Colin for his market update.
Thank you very much, Jason. So I thought I would just give everyone here an update on where we're at with current markets. Continuing with the equity action call, our first level of analysis remains in the green zone. We've had a good rebound in the markets here, and so far the markets have held up following this rebound. We've retraced about 50 to 60% of our losses in most of the major markets, and so far, while things have settled down a little bit, and yes, we're off a little bit today, but basically we're still in the green zone. We're still in an environment where we're seeing the risk return for stocks relatively favorable relative to non-equities. In terms of our asset class rankings, we're very similar to last week. First place continues to be international equities, and US equities are in third. Interestingly, we still have cash up in second. There's a lot of cash has piled up on the sidelines, and that is a potentially bullish scenario for stocks, because some of that cash may have to get put back to work, and if it does, it could find its way back into equities. So cash currency second and fourth, and international US equities first and third. Then in the bottom half, we've still got Canadian equity and commodities. Those kind of are also somewhat going together a little bit, since a lot of the reason why we're seeing those two depressed is because of the low oil prices. I'm going to speak a little bit to energy later on in this presentation. And in seventh place, we still have the bond asset class. What we're seeing in a lot of ways in the market is what I've been calling moving back to the middle, and I'm going to highlight this as I go through a series of charts in a couple of slides. And that is that we've seen extreme moves across world markets from January and February, extreme optimism, things were going to go great, new all-time highs for US indices, and then kaboom, down to extreme pessimism. The world markets just got hammered and had the rug ripped right out from under them. As I noted, since then, we've seen a lot of markets around the world have retraced about half of their losses. So if you had started to build a range from the February highs to the March lows, we're back in the middle somewhere. The other thing we've seen was the stampede in and out of a lot of the, we'll call them the safe haven asset classes, the US dollar, the bonds, gold. They all appear to have peaked and are also kind of starting to move back a little bit. We'll call it reverting back to the mean. The other thing is the VIX volatility index has finally started to come back down in a fairly meaningful way. It's up slightly today with some of the volatility following Powell's comments, but basically overall, the big stresses we've seen in the markets in late February and March have continued to ease. And so we're finding ourselves moving into a middle ground between reasons to be optimistic and reasons to remain a little bit cautious. So reasons for optimism, economies are slowly but surely starting to reopen, and the stock market historically has been forward-looking. Investors seem to be anticipating a recovery. Earnings season has been winding down, and results weren't great, but I don't think in a lot of cases they didn't seem to be as bad as feared either. We didn't see as many a certain number of companies cut dividends, but not as many as we might have thought. Some companies cut buybacks, again, not as many as we might have thought. And overall, the things weren't too bad. It looks like the bigger impact hit for a lot of companies more in Q2 than in Q1. Markets have continued to recover in the last week, despite the huge monthly US and Canadian job losses that had been announced. Now, a lot of that's been coming out through the weekly reports. We'll see weekly jobless claims in the States tomorrow. We've been seeing anecdotal reports out of Canada. There was a mid-month report from Statistics Canada. So some of this has been anticipated, but still, even then, we're still continuing to see this data. It's just that people are starting to anticipate now that, yes, then the current data is going to be pretty bad, and that still seems to be the case. The next big reports economically are Thursday night. We get Thursday night and Friday morning, we get retail sales reports for China, the US, and Canada. So that could be the next round of data of note. We're still seeing a massive central bank and government stimulus. The central banks are rolling. Powell was talking this morning. He wasn't hugely optimistic about the US economy at this point, left the door open for the Fed to do more. Although he did, it looks like, squash negative interest rates, the Fed could do more with quantitative easing and asset purchases. The Bank of Canada could still do more. The Canadian government keeps rolling out every day or two fiscal support for different sectors and different groups. In the States, they're still talking about more fiscal support as well. So that's all still in there and supporting the economies and through this time of high unemployment and low economic activity. And another one is the energy market in particular. We're continuing to see people cutting production. There was talk, there's talk about the top down, the treaties, the OPEC pluses, but then on the other hand, you're also getting the bottom up, the response to low prices. The big energy and small energy producers in North America are cutting on their own because they can't make money at low prices. And one of the biggies was Saudi Arabia. There have been reports this week that they're looking at cutting another 1 million barrels in June and hopefully trying to encourage others to do the same, basically because they can't make any money at these prices. And that's the bottom line. And eventually the economics does work eventually. Sometimes it just takes a little longer than people might hope for. There's also reasons for concern. So there's reasons why there's good reasons to suspect that the market could continue and equities could continue to get support in the near term and remain well above the March lows. On the other hand, there's some reasons for concern out there that overhang stocks and could keep us in the near term from getting back to the February highs. And number one of which is nobody really knows what reopening is going to look like. We don't know. I refer to it as turning the lights on the soccer field. It's when you turn them off, the lights all go off. When you turn them back on again, it takes a while for it to warm up, and some of them turn on more quickly than others. And that's the kind of situation where we're into at the moment, where some sectors may recover from faster than others. Some could get back to business as usual quite quickly. Others could take a while before they get back to pre-shutdown activity levels, particularly things like airlines in particular. A lot of them have said it could take quite a long time before they get back to where they were. a lot of companies out there, the one consistent thing we saw during earnings season was just about everybody suspended their guidance, which means basically managements have no idea what the future holds. And if the managements don't know what their companies are going to do, it makes it difficult for investors as well. And that's something to consider is how long could a recovery be? How long could how strong could a recovery be? Nobody really knows at this point. And the one out there is lingering out there is that the next round of earnings in July could bring more disappointments because, as I mentioned, it does look like more of the impact of this is likely to hit companies more in April and May perhaps than March, because a lot of companies didn't really start to get hit until the last couple of weeks of March. Only a few companies cut dividends and buybacks this quarter, but we may see more of that next quarter. They were cutting costs to preserve their dividends. But the other one is that in certain areas, and this was something Prime Minister Trudeau mentioned earlier this week, is for larger companies to access bailout funds, the governments may force them to cut dividends and share buybacks, and that could take some of the wind out of the sail of certain stocks. So it's something to keep an eye on. And finally, the things that are rattling out there longer term, at some point we could see more bankruptcies increase. That's often a little later on after you get your initial shock, and then 6 months or a year later you start to see more companies run into trouble, or in some cases governments may need to raise taxes. Saudi Arabia tripled their retail sales tax from 5% to 15% to pay for the money that they're using to support their economy, or they may have to continue borrowing, and that's a big one. And we've seen that in the bond markets already, where it looks like there's quite a supply of, well, on the one hand you have the central banks buying, on the other hand all this borrowing by governments is eventually going to find its way back into the market as well. So those are longer term concerns that are out there that could overhang the markets and potentially limit the upside. And that leaves us, as I mentioned, kind of sitting in the middle and swinging back and forth between the end zone lines is kind of where we're at. And those seem to have been pretty clearly drawn now for at least the near term. So I thought I'd start with our SIA market equal weight index. And as I move through these slides, by the way, you're going to see a series of horizontal arrows. I drew these horizontal arrows at the 50% retracement line to give us an idea of kind of where we're at in terms of the midpoint between the highs and the lows of the recent swings. So we can see here in the market overall that we've gained back a little bit more than 50%. A common retracement for markets just in general, and not now, but going back for years and decades, is 50% to 62% is a common retracement, and that's where we've been finding ourselves with a number of markets. So things, as I say, have come back really nicely. There's reason to be optimistic, but there's also reasons to be cautious as well. And so we are still, we're short of the previous highs, so there is some room to run if things do continue to improve. On the other hand, I wanted to highlight the bonds. Bonds have really been volatile this year. They initially soared as stock markets plunged, and then when the central banks really started to come in, and the tensions grew, the bond markets kind of seized up, the central bankers had to come in, and now that we've had the central bankers in buying things that they hadn't before, like junk bonds, we saw a lot of capital come out of bonds and then get redeployed into equities. Now we've seen this has also started to come back, and similar to equities, we've seen bonds have kind of retraced about 50% of their losses. They're now sitting in the middle, and so in this case, the highs and the lows are the support comes from the buying of the central banks, and the upside could be limited by the fact that governments are looking to borrow, and we could see markets get flooded with treasuries, and that could limit the upside. And we're finding ourselves in the middle. So again, this is one where there's a sideways trend starting to emerge. I mentioned the VIX a little earlier in the presentation. I thought I'd put this chart up. It's a longer term chart. This goes back to 2014, and it shows that generally speaking, the VIX had been in a sideways range of about 9 to most of the time to about 25, and then sometimes it peaked up to 45. This time we went up to more like 85, and we've been slowly coming back down. And the important part of this is that we're in a range We're coming back down. There's still a bit more room for the VIX to come down before it gets back into the middle of its historical range, and it actually is up a little bit today so far, just with the markets pulling back a little bit. This is the S&P 500 index. It's another example, an index. This chart goes back to 08, 09. You can see it was in a long-term uptrend, and it started to go sideways. And in some ways, this sideways trend actually almost started at the beginning of 2008. We had a rally up, we've had rallies down, but we're starting to move into kind of more of a range. This wide range is between about 2,200 and about 3,400. The midpoint of which is around 2,750, and we are seeing a little bit of resistance right now kicking in around 2,950 or just short of the 3,000 round number. So overall, we're still on a bullish signal on the spread double top. We're still in an upswing, but at the same time, we are, and there is still upside back to the previous highs, but we are counting some intermediate resistance in the near term. This is the Dow Jones Transportation Average. I did want to highlight the, in last week's presentation, Jeremy highlighted a number of the sectors that have been doing really well, like internet and healthcare and drugs and things like that. And this week, I just wanted to note that there are a few sectors that are actually still struggling, and one of them is the transports. And we've seen the rebound has been fairly moderate so far, less than 50% retracement, and transports are an area that could continue to struggle. The sector's just been decimated by COVID-19. There's high potential for bankruptcies or bailouts in the group, particularly among the airlines. The airlines have seen their traffic and their business absolutely gutted, and when it does come back, it's hard to say how fast are passengers going to come back. Are they going to fill their aircraft or have to put people in alternate seats, or what's going to happen there? And so there's a lot of uncertainty with regards to that. And so certainly there's transports related to trade, like the rails and things like that. But the airlines are one area in particular that could struggle and face an uncertain future. So some areas could bounce, even within things like the transports. There are subsectors, and some of them could bounce back faster than or more strongly than others. This is the TSX 60 index, and it's interesting when I look back to the chart Jason showed, going back to the of the TSX going back to 2000. I've got this chart here, which shows that really actually back for the last 10 years, the S&P TSX 60, the biggest caps have swung upward and downward in a fairly wide range, and that you're back to just kind of sitting in the middle, and really about where you were about 10 years ago. And so that's important, and I think it highlights the importance and the significance of relative strength analysis, of focusing on the stronger areas within a market rather than just looking at the overall market, because the overall market from time to time can just end up going nowhere. And but even in a sideways market where the broad market might not be going anywhere, there's pockets of opportunities, and there's areas to focus on and there's areas to avoid. And I think that's a really important message to take away from a slide like this and from the one that Jason showed at the top of this presentation. This is the US dollar index, and what I wanted to highlight here was how we saw in March there was this huge upswing in the US dollar, and it has now eased back as well. So the flood of capital that stampeded into the US dollar has been coming back out slowly but surely. And so like other assets, the US dollar has kind of slipped back into the middle of a wider range as well. And gold. One other thing I did want to highlight in this was that we often do see the when capital goes into safe haven assets, there's the US dollar, there's gold, there's the yen. Something that was interesting though is we have seen more strength in gold than we have seen in the US dollar. And looking at our and in particular here, while the US dollar has come back into the middle of its range, gold is still in the upper third of its range. It's come back off a little bit, but it's still more or less has been attracting support in and around 1700. And the reason for this is, I think in a lot of ways, is that gold being a hard asset has held its value a little better, and in particular in the face of so much central bank stimulus, asset purchases, Powell hinting at more asset purchases, and all those asset purchases devalue paper money, and they devalue paper currencies relative to gold. And there's one thing where a lot of people will look at currency trading and look at the various paper currencies against each other, but then there's gold, which is a whole other thing, and gold can benefit relative to a general devaluation of the value of paper money, which is something we could see coming between the massive amounts of debts, the massive amounts of quantitative easing and things like that. And because of that, gold has held up. So like other things that have been reverting back to the mean, means that gold could be a little bit vulnerable in the near term. It's hanging around 1700. The middle of its range is around 1625. But overall, gold's been attracting quite significant support relative to its peers like the US dollar. And my last chart slide here is crude oil. We have seen crude oil start to bounce back. We're seeing inventory decrease. The pace of inventory increases in the States and other places is slowing. We're seeing more people talking about production cuts, and there is the potential that that demand could start to rebound a little bit as economies reopen. So we've seen this year a range of low 60s to about $10, and yes, for oil, of which the middle of this range is around $25, $30. And we kind of have bounced back in that. We're still a little bit below the middle of the range, but overall, even with crude oil, it does look like we're starting to see kind of a sideways range form, but in this case, it's at a low level relative to historic, say, rather than the S&P 500, which is going into a sideways range at a high level relative to where it's been historically. And at that point, that concludes my our prepared remarks. So we would be happy to take any questions at this time.
Thanks, Colin. Jason here again. And just a reminder for anybody who has any questions, please don't hesitate to type them into the question box. To start, actually, Colin, I have a few questions here. If you wouldn't mind going back to the asset class ranking slide near the beginning of your presentation. And obviously, this is a often asked question, but again, if you could just go through, given all the, I mean, it depends on the week you're looking at. People are incredibly optimistic or incredibly pessimistic, depending on the news coming out. What would have to happen again for us to move back into the red zone in terms of what we'd have to see with the asset class rankings here?
Well, in terms of the asset class rankings, it's quite interesting because what we have here is it's basically measuring the performance of the three equity asset classes versus the other asset class, the non-equity asset classes. So right now what we're seeing is we're kind of split at the top, where we've got cash and currency and international and US equities both kind of splitting the top four asset classes between them. So a couple of things you would think if we were going to go back into yellow or red is you'd be looking for a weakening of the asset classes. You'd probably be looking at cash and currency moving back up and international equities and US equities moving back down. The Canadian equity moving down from fifth would probably not have much of an impact. The other thing that could have an impact would be if we started to see bonds move back up. In seventh, a significant move upward in bonds, particularly if you saw bonds moving up and the equities moving down, could be enough to trigger a change as well.
Yeah, and a follow-up question to that, with bonds in seventh place, what would we have to see for bonds to move back up, given everything that's happening right now in the bond world?
That's a really great question. So you would need to see bond prices increasing and yields falling. Now, what could cause yields to fall? If the Fed changed their mind and went to negative interest rates, could cause yields to fall, or if people just start to get a general sense that the central banks could be coming in with a new wave of something. Basically, it would need to be something that would push interest rates, traded interest rates, lower than they already are, but they're already pretty low. The 10-year Treasury is down around 0.6%, and you still have all that potential issuance out there that could depress prices.
Right. On your Q1 chart book, Colin, you had a chart there that talked about the markets rising on lower volume, on declining volume. I know you don't have a chart on that in this presentation, but can you sort of speak to that? Are we still seeing low levels of volume, or is volume starting to increase on the equity markets here? What are you seeing on that?
It has been, overall, it's just kind of like a lot of other things, it's kind of stabilized. So we had a big sell-off on massive volume. Like these were, the downward pulses we saw in February and March were on huge levels of volume, and a lot higher than we had been seeing of late. Prior to that, they were huge volume spikes to the level we hadn't seen in years and years and years. When we saw the rebound, that was on falling volumes, but it's not necessarily that we fell to low volume levels. We just kind of have come back more to like a longer term average. So it's more a case of we were rebounding on decreasing volumes, which indicated that the selling pressure was easing, but we haven't gone down to the point where we would say, well, it's low volumes, there's no buyers left. We've just kind of come, like a lot of things, we just kind of come back to the middle.
Great. Another question here was if you can speak about the NASDAQ outperformance relative to like the Dow and the S&P 500. NASDAQ has seemed to be more resilient to challenging days in the markets. Can you speak to a little bit about what's happening there relative to, say, the S&P 500 or the Dow?
Sure. Well, the Dow and the S&P 500, and in different ways, have let's call it a wider variety of sectors represented, and a higher representation in those indices in sectors that have been struggling. So if we look at the NASDAQ, the NASDAQ is focused more in areas that in some ways have either not been hit as hard by the pandemic, or in some cases have actually benefited. So higher healthcare, biotech, higher technology, internet, and actually the S&P has a fair number of regional banks as well, but that's another thing. But generally speaking, though, but what the S&P is lower in is it doesn't have that many transports, it doesn't have that many energy companies, and those areas that really got hit hard are less represented in the NASDAQ, and in some ways the NASDAQ is more represented in areas that, as I say, could either be less affected or actually benefit. For example, the internet and internet commerce has taken off from all of this with people at home, rather than out and about, or certainly say biotech with companies that are looking for COVID cures or COVID vaccines or what have you, or just healthcare in general. Higher spending on potential spending on healthcare in the future has supported those kind of sectors. So it's a matter of the composition of the index is what's happening there.
Okay, great. And the last question that I see here, and I know that you have addressed this before, and Jeremy's addressed this before as well, but a question we get often is, how vulnerable are we to moving back down into the red zone over the next short term, let's say, 1 to 3 months, given everything that's happening here, and given all the support that we're potentially getting, and maybe even more from the central banks going forward, who knows? But how vulnerable do you think we are just over the very short term here of moving back into the red zone?
Well, my current thesis is that we're moving back into the middle, and we're just kind of settling out, and that we've got these positive and negative forces pushing against each other, but that generally speaking, we're kind of neutral to slightly positive at this point in time for the next 1 to 3 months. The biggest concern to me is what's going to happen about 6 to 8, so it's probably about 8 weeks from now, when the next earnings season starts. It could be the next pressure point in terms of what happens with companies reporting, how quickly do they recover through this quarter, and by then will markets have had time to investors had more time to digest this and figure it out. It's a case where we had in February and March was just a massive shock to the system. It was a massive readjustment of expectations, and now we're at a case where, yes, people are optimistic, but they're cautiously optimistic, not unbridled optimism. And, or, you know, people that are concerned, well, there's concerns out there, but it's not the panic that we saw a few weeks either. So my feeling is that we're still in a neutral to bullish phase for the market that could persist for some time yet in terms of the near term through the rest of this quarter anyway.
Okay, great. Thanks, Colin, for all those questions, and thanks everyone. I don't see any more questions here, so we'll end it here. Once again, thanks everyone for your time today. If you have any questions for any of us here at SIA Wealth, we have a big team here. Please don't hesitate to reach out to us. We'll be more than happy to set up calls or even virtual meetings with you as well if you want to go through some stuff into more detail. Other than that, everybody stay safe, have a great week, and we'll pick up next week. Thanks everyone. Take care.